All right, I'm going to start off the weekend report with energy. Um, I think over the long haul, probably the best percentage returns are probably going to be in the oil service sector. It's kind of like betting on the juniors in the precious metals mining sector. They've The service sector has gotten hit the hardest during this bear market, and I suspect they're going to probably have the biggest percentage gains. So if you want to take an old turkey position in anything, XLE is acceptable, but I tend to think you're probably going to make better gains over the next 4 or 5 years by just buying and holding OIH, which is the oil service ETF. I don't see any reason that the oil service couldn't retest the all-time highs during a big bull market, 4 or 5 year bull market, and that would be quite a large percentage gain, especially considering this is an unleveraged fund. So you don't necessarily have to worry about decay in this particular ETF like you would with a double or triple leveraged fund. With those, you would have to try and trade in and out of intermediate cycles. With OIH, you could just buy and hold it for the next 4 or 5 years. All right, moving on to stocks. We've now got 3 days in a row that have held above this breakout level. There's still a slim possibility that we could get a half cycle low that could come back below this, maybe stop some people out if they have too tight of a stop, and then reverse and continue up. I tend to think that I've kind of seen everything I need to see at this point, that I don't think I would use a stop at this juncture. I think we're either starting the second phase of the bubble, or we may have to have one more tiny little dip into a half cycle low, and then we're off to the races. In a bubble phase, cycles probably aren't going to work very well. We may not have half cycle lows. We could just start, get into a runaway move, kind of like this. This was more or less a runaway move. Didn't really have much in the way of half cycle lows or even recognizable daily cycle lows for that matter. And the second phase of the bubble may be even more intense than this first leg up. So I'm going to say, use cycles with a grain of salt. They just may not work in a bubble. And so I think you just want to get in and hang on and not try and dodge pullbacks that either may not come or may come later than you expect. You end up exiting and then having to chase and missing part of the move. So at this point, anyway, like I said, 3 days above 1200, I'm convinced that we're either starting that second phase of the bubble, or if we do have to have a minor dip next week, that it isn't going to amount to much. And so you might as well just get in and stay in. Now, if you're wanting to play some options on this, my suggestion, the bubble phase, any bubble phase, tends to last about a year. Sometimes it might be a year and a half. This one started in March, so we would expect a top to occur sometime beginning in March to maybe June. So if you're going to buy options, you want to go past that. So I would say the earliest strike price that you're going to want to use if you're playing options would be June, and August or September might even be better. You would have a little bit more margin of error. As always, deeper in the money is safer, less chance of losing all of your investment if if something goes wrong. If a whole bunch of states start closing down again and the second half of the bubble phase gets aborted, you have less chance of losing all of your investment. If you're deep in the money, you would probably recognize that something has happened before price goes back below your strike price, and then you start losing money quickly. So safer to go deep in the money, more leverage with in the money or out of the money stocks. I'm not going to give my blessing for anybody to go more than one or two strikes out of the money. And I don't think you should try and go all in on this anyway, because at some point, even if we are starting the second phase, it's going to get volatile. We're going to have some big, maybe even as much as 10 or 15% swings in 3 to 5 days on the way up. And if you're all in on options, that is going to be nerve-wracking. it's going to be very hard to hold on to the trade, and um, you may end up stopping out long before you really should have, just because you couldn't hang on to your huge option position during a really volatile corrective move that would probably soon get reversed and then continue up. All right, moving on to metals. As I noted in my Friday morning report, gold has now broken through three support zones. The all-time high at 1923, that was lost, obviously. And then we broke through this 1850. That, of course, triggered a lot more stops. That's why we're getting this bloodbath phase here. We broke through 1800 today. I am not sure that we are done with this yet. We've kind of come down into this midpoint consolidation zone, but we're only really 4 days into the bloodbath phase. They can last, usually they're 5 to 7 days. I have seen some of them that last even longer, up to 15 days. So I'm not convinced that we've completed the bloodbath phase today with this break of 1800. The first thing I'm going to need to see is a swing, of course. That could only happen on Monday if price were to move back above 1822. I would also need to see a really heavy volume up day in JNUG or Nugget, or preferably both. Obviously, we didn't get that today. It was a half day, so we weren't going to get any huge volume in any of those anyway. But I see a lot of people assuming that the relative strength in miners means that today was the bottom, and I am not at all convinced that that's the case. I think you should wait for a swing and wait for that heavy volume up day in the leveraged ETFs. And as I said in my morning report on Friday, I think we've probably done enough technical damage that even if, when we do create the bottom, I suspect we're going to need 3 to 4, maybe even as many as 6 weeks of churning and basing before we can actually start getting some momentum to the upside. So, if you're wanting to buy options to play the next intermediate cycle in gold, you're not going to be able to, I don't recommend you buy options that are going to expire in 2 months, because you may just get caught in a choppy basing pattern, and then all your time value evaporates before the momentum move begins. So metals they just don't bottom like stocks do. They don't V out of it very often. And at this point, there's so much technical damage done that I have my doubts about a V bottom here. So if you're going to buy options, I think you need to go out to June or July with those options, so that you've got some protection against maybe 4 to 6 weeks of back and forth basing before we actually take off and start higher. My recommendation at this point, I think, would be to focus mostly on the stock market, because I think the momentum move is getting started in stocks. And let's just kind of see how the metals play out. Really, until gold gets back above 1850, there's little chance of any momentum really getting started. So even if we get a bottom early next week, we could chop around between 1850 and that bottom for a while. So I don't think there's any need to buy options in a big hurry to play the next intermediate cycle until we've got some indication that the momentum has started, and I just don't see that happening until we at least recover this 1850 breakdown zone. Another concern is that silver hasn't made a lower low yet, and I doubt that this bloodbath phase is going to be over until silver gives us one more of those big, nasty, something that looks like this, these big, nasty whoosh down type move where a bunch of people stop out and you just get this selling panic. I suspect we're going to tag the 200-day moving average, and let me put that in. All right, so I would be leery about trying to call a bottom until silver breaks this low, and we're probably going to have to test this 200-day moving average. So let's just have a little more patience. We're only on day 4. That's probably a little bit too early for the bloodbath to end. I'm thinking probably sometime um, mid to the end of next week before we get our final bottom. And if you want to play this even a little bit more safely, you could just wait for a weekly swing rather than a daily swing. So in gold, you can see we've got a big candlestick this week. I would like to see a smaller candlestick next week, and that would ease the parameters for us to get a weekly swing. And you can also see from this chart that we're still a long ways above this 200-week moving average. And since gold is not um, entering into a bubble phase, this is a concern. Whereas in stocks, yes, we are stretched way above the long-term moving averages, but I think stocks are in a bubble phase, and it's not going to matter until it does matter. And then at that point, I think the bubble pops, and then bad times start. But um, for gold, if you want to play this safer, you just wait for a weekly swing. Unlikely that's going to happen next week, and we would prefer to see a much narrow range, smaller range week next week, and then that would ease the parameters to form a weekly swing the week after.